I'm Monica Gibson, and today I'm joined down the line by FX Strategist Raghav Subbarao for our Euro-themed targets in focus, concentrating namely on Euro-dollar, Euro-sterling and Euro-yen. So Raghav, the market is trading with low volumes and is missing a massive Euro buyer today in terms of China, as many Asian countries are celebrating New Year. But how would you sum up market sentiment in general at present?
I would describe market sentiment as being optimistic, and the reason for this is the improving euro area financial conditions. Now, this has been happening for a while, and if you had to pick a specific date, that would have to be the 26th of July last year, when Draghi indicated that the ECB would do whatever it takes to save the euro. So since then, we've had the announcement of the OMT, we've seen a massive improvement in financial conditions, but I think really, the massive leg up occurred in January when market participants returned after the New Year and realized that things have improved, and that combined with the fact that the ECB wasn't considering a rate cut anymore led to the euro shooting higher. Over the past week or slightly more than a week, I think that optimism has become slightly more cautious, and the immediate cause for that I would say were the headlines coming out of Spain regarding the corruption in the political system over there. And it kind of brought back to markets, reminded market participants that the political risks remain very much alive. So while their situation definitely has improved, there are still risks out there. So broadly, I would say it's cautious optimism at this point.
If we look at the first currency pair, the major event risks for the euro-dollar rate are again concentrated towards the second half of this week. Those are the US retail sales data on Wednesday, Germany and EU GDP data, as well as the ECB monthly report released on Thursday. The market consensus does not point to a very strong data, but what is your outlook for this pair moving forward?
Officially our 1 month forecast is 138, but we kind of made that forecast when euro-dollar was at 137. Further out 6 months, as you said, we expect it to go to 132. So the way we look at euro-dollar is that conditions definitely have improved, which does justify that the euro is quite as weak as before. That being said, we think euro-dollar in the high 130s isn't justified by fundamentals. So while sentiment has improved, we haven't really seen cyclical economic data improving to the same extent. If you look at the PMIs that were released in January, they showed a really large divergence between Germany and France, between Northern Europe and Southern Europe. And I think, as Draghi reminded us at the press conference last week, is a strong euro does have an impact on growth forecast. It does have an impact on inflation, and consequently, should we see euro strength, the ECB is likely to act. This is not to say that they're targeting the exchange rate, but currency strength doesn't happen in a vacuum, and a stronger euro will have an impact on growth and inflation, and the ECB does have an inflation target, and consequently they will likely loosen policy. That being said, there's also a US side to this story. Our economists' base case is that the Fed is likely to start tapering the QE3 purchases. So as of now, they're purchasing $85 billion a month. We expect that to go down to $40 billion by the middle of the year, and that is going to be a surprise to the market. And if that happens, it is going to be supportive of the dollar, especially against the other G4 currencies. So putting both of those together, and combined with the fact that we think US growth is going to be much more positive than euro area growth, and consequently also have an impact on relative monetary policy prospects, we think the euro at 137 wasn't quite justified, which is why we expected it to maybe shoot higher a bit on the back of positive momentum in the near term, but medium term we still think euro-dollar will move lower.
Some analysts have said this week could be vital for the future of the euro-sterling, and that the 84 level could very well see a bit of support. Do you agree with this forecast?
The euro against the sterling is an interesting pair. What we saw in January was that sterling weakened significantly. So that was primarily due to two factors. And most market commentary pointed out that the euro area situation is improving. Sterling was the safe haven for euro area capital flows. Reduced safe haven demand should lead to a weaker sterling. The second issue that they pointed out pointed to was that the UK cyclical position was very weak. We got very weak Q4 GDP numbers, and this would eventually get reflected, except maybe further easing from the MPC, weakening sterling. I think that kind of is a very superficial reading. In fact, if anything, I would suggest that market commentary, especially the NPC statement last week, what it did say was that inflation is going to be above target, and from their perspective, the bar for further QE remains high. This is not to say that QE can't happen if the situation deteriorates significantly, but as of now, we don't think there's going to be any further policy easing from the MPC. We don't think there's going to be any more QE, and therefore sterling is likely to do relatively well. The second thing I would point out is that while the euro area is likely to gradually improve, it's not going to be a smooth process. So we have event risks. You mentioned earlier the elections. So we have the Italian elections coming up at the end of this month. We have the German elections later in the year. And as the Spanish headlines pointed out, there are other political risks which could lead to a correction in the euro. So broadly, in our view, euro sterling at 87, which was where it was when we made our forecast, was simply unjustified.
And finally, the euro yen is downside corrective at the moment, but the market is expecting a very active Bank of Japan in terms of monetary stimulus. Therefore, what are you expecting from this pair in the short, mid and longer term?
The story so far has been that the euro and the yen have occupied kind of the opposite ends of the spectrum in this theme of currency wars. On the one hand, you have the BOJ, or at least, if not actually having done something, the market's pricing expectations that they will be very, very activist. We'll see a massive loosening of monetary policy. There have been ideas thrown around such as a foreign bond purchase fund, etc., all of which will lead to a weaker yen. And at the other end of the spectrum, you have the ECB, which has been very conservative, which refuses to accept that they would target an exchange rate, and that's driven euro-yen, sharply higher in 2013. That being said, our expectation is that both the euro and the yen will weaken against the dollar, but the yen is likely to have a much sharper depreciation. So if you look at our forecast, we kind of have it moving to 128 in 3 months and 127 in 6 months. I think the risks are to the upside of those forecasts, because we think this time around the Japanese policymakers are quite adamant to get the 2% inflation target. We haven't seen the announcements so far, but they will announce measures eventually to make the currency weaker to achieve the inflation target, and that is likely to weigh on the yen. So given our expectation that the yen is likely to weaken more than the euro, we think the prospects for euro-yen are to the top side from these levels.
Well, that's all from Raghav and myself for the moment, but please click back to Dukascopy throughout the week, where the TV team will be keeping you up to date with the very latest Forex-related financial news. Bye for now.